Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to the lowest rates at the lowest costs. Who doesn't want that in Arizona? And if you don't believe me, call me. Here is this week's mortgage market at a glance. Over the past 30 days, interest rates have risen sharply. This is true for both mortgage rates and bond market benchmarks like the 10-year Treasury yields. But another version of the 10-year Treasury yield continues to operate near all-time lows. Inflation. As I discussed last week, inflation erodes the value of bonds. As such, bond yields frequently move in response to changes in inflation expectations. Higher inflation equals higher rates. That correlation is easily seen in the following chart. Well, for starters, the Federal Reserve immediately began buying massive amounts of bonds shortly after the pandemic began. This acted to keep yields lower than they otherwise might have been. Beyond that, there had been, and possibly still is, some reason to believe that the post-pandemic inflationary pressures are temporary and thus not alarming enough to warrant a surge toward higher rates. Between now and the time that inflation subsides, if it subsides, the mismatch between 10-year yields and inflation expectations means the actual rate of return, factoring out the effects of inflation, is still near all-time lows. In other words, the real rate of return for 10-year treasuries is low. Unfortunately, this doesn't do much good out in the real world. It just is an economic concept that helps us reconcile the reasons for rising rates. And rates have certainly been rising. While it's hard to see given the scaling of the chart, even the inflation-adjusted rate of return has been moving up recently. A big reason for this is the growing level of concern over inflation trajectory. Several months ago, policymakers were more confident that supply bottlenecks would only result in temporary inflation spikes before prices began to settle. But I'm not seeing things settle down as quickly as they expected. And as a result, market participants quickly ramped up expectations for the first Fed rate hike. These expectations are conveyed via the trading Fed funds futures contracts. Each contract pertains to a calendar month. The following chart shows the July and October 2022. These would correspond with the scheduled Fed meetings that take place in June and September of 2022, respectively. The higher the line, the more the market is betting on seeing the first rate hike by the calendar month. At the beginning of the month, traders only saw a small chance for the first rate hike happening in September and no chance for June. Fast forward 3 weeks and September is seen as 100% likely and June is up to about 60% chance. Before the Fed hikes rates, they must be all the way done buying treasuries and mortgage-backed securities. This isn't a guess or an opinion. It's something that multiple Fed speakers have asserted time and time again. As such, the market quickly came to the understanding that the Fed would have to taper soon and possibly in larger chunks compared to 2013. This is one of the reasons that rates have risen as quickly as they have in the past few weeks. Tapering has a massively negative connotation to anyone who turned into 2013's drama, but it's important to remember that we've already seen quite a bit of the bond market tantrum this time around. It was much more orderly because we knew it was coming and even roughly when it would come. This doesn't mean rates won't continue higher from here. Indeed, that is the baseline assumption for many traders through the end of 2021. But past precedent suggests rates are certainly capable of falling the very moment the Fed removes the accommodation. Remember, this chart from last week, which shows 3 major past instances of the Fed bond buying. Several housing-related economic reports received fresh updates this week. Homebuilder confidence was out last Monday with the first noticeable improvement in months. Residential construction data followed the next day. Building permits and housing starts, the groundbreaking phase of new construction, both declined but remain at higher levels than before the pandemic. Last Thursday's existing home sales report was stronger than expected despite record low inventories. Now, keep in mind, however, this is for the month of September, and as I just discussed, rates have risen sharply since then. Not only that, but there's typically additional lag between big rate changes and any impact on home sales numbers. That means mortgage rates are as much as 0.5% higher than they were when the sales data was being collected. Now, of course, rates aren't necessarily a leading indicator for purchase activity, but they definitely have an effect, especially on prices. This week brings an important update on home prices with both Case-Shiller and FHFA releasing monthly numbers for August. This is the second to the last month of data that will go into the calculation to determine next year's conforming loan limit. Prices have already risen enough for new loan limits to be roughly $627,000. Any additional gains in August and in September will only make the new loan limit bigger. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. So until next time, take care and stay safe.